Good morning. It's Tuesday, the 22nd of October, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The take. For several months, it's been clear, as we've been saying, that auto sales in India have been slowing down. A key indicator of that has been the rise of inventories at dealerships, now at a record 80 days. Using that benchmark alone, we've argued that there was a good chance this reflected a larger slowdown in consumption and in the economy, and also the end of a post-COVID era spike in spending. A Kotak Securities, a brokerage, report that puts out stock picks for Diwali day trade says the brokerage is now cautiously optimistic on India. Now that word sounds a little strange and distant given that no brokerage has ever used that word caution to describe the Indian markets even until a few weeks ago. So what's changed? Actually, it's the smart money, for one. The first to hit the reverse gear were the foreign portfolio investors who've now reportedly sold a record $10 billion or close to it worth of stock this month. They were mostly heading to China in a desperate attempt to catch the market there and its upside thanks to a series of stimulus measures that the government had unveiled in recent weeks. It also helped that Chinese valuations were low and Indian valuations were high. All the fleeing investors and the brokerages like Jefferies, by the way, swore by India's longest-term story even as they were dumping stock. Other brokerages like Bank of America and Macquarie similarly reduced India weightages and increased China. If Indian markets were indeed so full of promise in a consistent way, it's unlikely we would have seen that kind of exodus as we have. Most institutional investors have always pointed to earnings as the driver of market prices and valuations. Markets are a slave to earnings is the usual response that I've got when asked about valuations. But the latest earnings season has been slow in contrast to the past. A report in the Financial Express says net profits of a sample of 164 companies, including banks and financials, were up 7% year-on-year on the back of an 8% rise in revenues. So far, so good. But net profits would have fallen, the report says, but for a 23% jump in other income, which means income not from the core business. Importantly, the FE article says that across the board, miss and estimates suggest the street has been unable to gauge the extent of sluggishness in demand, whether for IT services or for consumer goods. Management's claim reasons range from muted consumer demand, elevated commodity prices, and higher advertising and promotion spends thanks to competitive intensity. The cautiously optimistic Kotak report, just to come back to that, points not to the earnings but to India's strong macroeconomic position, including an improving fiscal and inflation outlook. It also says that there is some modest improvement in laggard sectors of IT services and consumer staples. So it's actually not about what the report is saying, but it's actually about what it's not saying, which is the usual bullish cross-sectoral tone which we've been seeing across brokerages all these months. Now, there are several other data points like goods and services tax or GST, who's now growing at 6.5%, which is the lowest in 40 months, almost on par with inflation and therefore arguably very little or no volume growth. Elsewhere, real estate purchases, again, as we've been pointing out, are slowing. At the bottom end, it's almost stopped. And sales of old homes, as a recent report in the Economic Times says, have slowed as well. There are various positive data points, as we've also been reporting, as there should be. But broadly, this looks more like the end of a standard high-growth phase, which was more cyclical than a straight-up line, almost in perpetuity, as people would have you believe. And quite likely, this is a good development for the economy and markets as they cool off before resuming their upward journey in good time. The bigger question to me is how come no one saw this coming until almost at the last moment, like Bajaj Auto did when it suddenly almost out of the blue announced that two-wheeler festival season sales were clocking below expectations, or Ultratech Cement, which reported a bigger than expected 36% decline in consolidated second quarter profits on Monday, thanks to cement prices, which by the way are near 5-year lows. Many companies have pointed to the demand slowdown caused by heat waves, followed by elections, followed by heavy rains across the country. Now, does that mean the demand would have been hunky-dory were it not for these extreme extraneous factors and thus would roar back after, which is now? Well, it doesn't look like. The question really is, to what extent India Inc. knew that there was a more fundamental problem with consumer demand all these months? And did it not know or knew but somehow chose to stay silent? Neither answer is actually very comforting. And that brings us to the top stories and themes of the day. Foreign portfolio investors are in full-blown selling mode, unloading almost $10 billion of stock. The rupee hits a record close. Gold prices are up 32% this year. Chinese steel production drops and dumping could rise. India is revving up solar power but is also dependent on Chinese imports. A vaccine maker buys a film production house. Why could that be?
This is the Core Report with Govindraj Ethiraj.
The markets try for higher ground. The Indian markets tried hard to reach higher ground on Monday but could not. The BSE Sensex swung almost 959 points even as investors continued to sell. A sharp increase in HDFC Bank stock did not help either. Remember, it has a high weightage on the Sensex. The BSE Sensex closed at about 81,151, down 73 points. And the Nifty 50 was down too at 24,781. That's down 73 points. It's a record October with the highest ever selling by foreign institutional investors, with sales of close to $10 billion worth of stock, beating the close to $8 billion seen during the COVID-led market fall in March 2020, though the proportionate value this time is lower as the total investment value for foreign portfolio investors is much higher. Gold prices hit a high. Gold, which is considered a hedge against political and geopolitical uncertainty, has risen 32% this year. And it's up again for the fifth day now, obviously hitting fresh records thanks to the ongoing Middle East tensions and some uncertainty around the US elections, according to Bloomberg. Silver is also rising now at a 12-year high. Gold is at $2,733 per ounce and is now essentially back as a safe haven asset, with analysts now predicting a $2,900 per ounce mark over the next 12 months. Traders are also pricing in a 90% chance of the US Federal Reserve lowering rates in November, according to the CME FedWatch tool, said Bloomberg. Rupee goes low again. Gold might be up, but the rupee was at its weakest closing level on record on Monday. The rupee closed at 84 rupees 7 paise against the US dollar, a little lower than the previous close of 84 rupees 6 paise in the previous session. Remember, the range is always very low, but the fact that it's now below 84 is, of course, new. Foreign investors, like we've said, pulled out close to $10 billion from stock markets in October, and that crosses the roughly $8 billion in March 2020. The dollar index has risen nearly 3% in October thanks to expectation of shallower rate cuts by the Federal Reserve, alongside rising odds of a victory for Donald Trump in the upcoming US presidential election next month, according to Reuters. ING Bank said that forex markets seem to be positioning for a Trump victory, and several analysts, actually, as we've seen here, in both equity and forex markets appear to be pricing in a Trump victory at this point. Chinese steel demand shrinks. China will account for less than half of global steel consumption in 2024 for the first time in 6 years, according to the World Steel Association, as a decline in China's real estate sector hits or affects demand for steel, according to Bloomberg. India's market, meanwhile, will grow by 8% this year after rising 14% in 2023 to 143 million tons, while other emerging and developing economies will grow around 7% for the second year running, according to World Steel. China is at the structural peak in terms of steel demand. Simon Trott, chief executive for iron ore at Rio Tinto, the world's largest supplier of the steel-making ingredient, that's ore, said at an address in Melbourne on Friday, according to Bloomberg, and added that the world will need more steel in the next 20 years than it's used in the last 30, despite the growth that we've seen in China. World Steel also sees Chinese consumption racking up a fourth year of declines in 2024 to 869 million tons, while demand in the rest of the world rises slightly to reach 882 million tons. So if I were to wrap up those figures again for you, India is at 143 million tons, China is at 869 million tons, and the rest of the world is at 882 million tons. World Steel also said China's share will shrink further in 2025, and all of this appears to mark the end of China's decade-long infrastructure and property boom. Solar blazes away. India's ambitious goal of installing 500 gigawatts of renewable energy capacity by 2030 may drive the country's annual solar equipment imports to about $30 billion, thanks to an increasing and heavy reliance on Chinese goods, the Global Trade Research Initiative has said. In 2023-24, India imported about $7 billion worth of solar equipment, with China supplying about 63%. China dominates about 80% of global solar production and exports, controlling 97% of the world's polysilicon supply. I reached out to Ajay Mathur, Director General of the International Solar Alliance, a joint effort by India and France to step up deployment of solar energy solutions, to which 119 countries are signatories, which is to the ISA Framework Agreement. And I began by asking him to walk us through the key challenges in ramping up capacity in India and overseas, and the opportunities as well.
These are amazingly interesting issues. For one thing, when we are looking at India, doing the 500 gigawatts is no longer a serious challenge. The question is how much more can we do? And this is largely because in the last few months, we have seen the price of electricity from round the clock renewables to match that new fossil fuel plant, new coal power plants at about 5 rupees. So all the solar plus wind plus battery is 5 rupees minus, and all the new coal is 5 rupees plus. What it implies is that unless we need to take care that we have enough land, we need to take care we have enough transmission lines, we need to take care we have enough cash to invest in the upfront costs of these plants. If we do that, then it will be very, very likely that we reach somewhere near 750,000 gigawatts instead of just 500 gigawatts by 2030. That was one part. The second is, where do we get modules from? Today, approximately, something of the order of 80% of the modules used in India come from China. This has two problems. One is, of course, supply chain problem, because it takes time for these panels to come from there to here. The second is one of the cost, because for the cost, you are dependent on what the Chinese manufacturers want. We have seen that as far as going from solar cells to solar modules is concerned, that makes economic sense today. And therefore, you're seeing a lot of solar cells going to solar modules, those plants coming up across the country. We've got something like 20 gigawatts worth of capacity of going from solar cells to solar modules. We added approximately 15 gigawatts in 2024. So that's more than enough. The problem is making solar cells. Solar cells, China has been selling at an amazingly low price. And that's largely because the capacity that they have is approximately double of what the global demand is. And therefore, for the sake of survival, there are various plants which provide very inexpensive solar capacity just so that they can remain in business. Now, what it also means is that we will need to provide incentives for people to remain in the solar cell business. We are providing them through the performance-linked scheme, the performance-linked incentive program. And what we hope is that something of the order of approximately 15 this year and 25 next year worth of gigawatts of solar capacity will come in. So the solar cells to solar module guys don't need to buy from anybody else. They can buy from the made in India solar cell capacity itself. So my view is that solar cells to solar modules, I think we are already economically viable. Making solar cells requires incentives, and we have done that. So my feeling is we'll return the corner sooner rather than later. The third question that you had asked was about capacity. Now, very, very clearly, we need people who are trained in designing and managing solar plants, but also in the policies that are needed for the solar capacity to be made. We also need capacity to make sure that the grid works all the time. So remember, we're talking of solar and wind and storage and hydro and nuclear. All of this are carbon neutral. But what it means is that you've got electricity from one source coming in at one time, from something else coming up at another time. And therefore, we are looking at capabilities to manage the grid. This is amazingly important. The grid managers need to be trained to do this. This capacity building has started. There's a Green Skills Council, but the number of people that are needed needs to enhance dramatically fast. We are now going ahead with with the rooftop program, but we will need people who can manage those rooftop programs as well, those rooftop installations that are made. We need those people. We are looking, therefore, at something like a doubling of the capacity that we are producing today to what we need.
Right. Okay. So if I were to stay with India for a moment, can I ask you between, let's say, rooftop and grid power, how is that equation evolving now, given that there's a lot of subsidies going into rooftop solar support as well?
So we've got about a total of about 70,000 megawatts of solar power in the country. Approximately 55,000 is grid connected, and approximately 10 to 15 is rooftop. But remember, this 10 to 15, which is rooftop, was just 5,000 not that long ago, means a year ago. With the rooftop program, we are seeing a dramatic change. And we are seeing something of the order of, my belief, 1 crore households being connected through solar rooftops. That implies that over the next 3 years, we've got something of the order of 7 to 8,000 megawatts a year being added. So what we can expect is that we would have about 20,000 megawatts added to solar rooftop by the end of 27, 28 or so.
In terms of rooftop solar, and I mean domestic or household rooftop solar, would you say that the pickup in India has been similar to, let's say, other parts of the world? Or has the policy input of providing subsidies helped, and to what extent?
First of all, I think as far as consumer, I am now better off using solar electricity. If my roof can bear the weight of the solar, if I can connect it and connect it in a manner that it uses I use solar electricity instead of grid electricity when I want. So yes, the benefits are there. When I have excess solar, I can supply it to the grid using the net metering program that is available. How are we going? We are still in the very early stages, but I have no hesitation in saying that with this program, and this program policies only become better as we go along, because I've always learned from our experience. My own feeling is that we will reach the 20,000 megawatt goal in 3 years.
Right. So as we reach, as you said, parity in terms of cost of power, what else are the key policy challenges, or for that matter, even investment challenges, whether it's public or private sector ahead?
Let me start with the financial challenges. Even though the cost of electricity from grid-based renewable electricity, round-the-clock renewable electricity, is now less, what it means is the capital cost is still much more. The capital cost is twice. 100 megawatt coal unit will cost about 900 crore rupees. Solar plus wind plus a storage of an equivalent capacity will cost about 1920 crores. By itself, doubling the amount of financial resources that are needed is not all that great a challenge for a country like India. But what it means is that there are many other sectors which would be starved of money. So you can almost hear them sucking the money out. One way of handling it is to enhance the velocity of the money that is invested in the solar area. So the same money, instead of being invested for 7 years, could be invested for 3 years. Then you could do it twice. Now, what will happen after 3 years? What we can do is build up the bond market, Govind, so that your pension money and my pension money can be invested in these solar projects, and they get an annual return and pay me. And in the process, they also get funded. So because the projects are ready in 2 years, take the money out after the third year, replace it with bond money, and then give the same money to the next project.
Right. Let me supplement that last question. Any unfinished agenda?
Big unfinished agenda. I think the key issue is land. Where do we find the land? Now, back of envelope calculation suggests that the Thar Desert is large enough to meet all of India's needs in 2070. However, we don't want that. We want solar to be much better diversified across all the states of the country. The issue is, how do we get the land? We have great examples from the wind energy area where, for example, in Tamil Nadu, the land was first bought, then it was leased, and then just the points on which the wind tower was placed, only that was leased. I think what state governments need to do is to purchase pieces of land, and then they can resell them or release them, depending on however they've got it, to solar developers. That would, I hope, make chunks of land available. These chunks of land are also important because what it allows the transmission company to do is build transmission links between these chunks of land and the place where electricity is used. This availability of land will help me as a developer to go to these chunks of land closest to where I have my PPA. That will give me the certainty that I will get the project and I will build it as well.
Right. Dr. Mathur, thank you so much for joining me.
Thank you. Thank you very much, Govind.
A vaccine company buys a film production house. In entertainment news, a vaccine company, or its owners to be more specific, are acquiring a film production company. Adar Poonawalla of the Serum Group in Pune, known mostly as makers of vaccines, are acquiring a 50% stake in Karan Johar-run Dharma Productions at a valuation of 2,000 crore rupees. Brokerage Elara Securities said the 1,000 crore infusion will enhance capabilities for the production company to make large budget films, pointing out that an average budget for a large-scale Hindi or Bollywood film is in the range of 200 to 300 crore rupees or 2 to 3 billion rupees. Dharma was in discussions with several companies, including Saregama, part of the RP Sanjeev Goenka group of companies, and Reliance Industries, and had also been reporting losses in the last 2 years on lower revenues. The production house was founded in 1976 by Yash Johar, that's the father of Karan Johar. I spoke with well-known entertainment industry journalist Vanita Kohli Khandekar for her take on the deal and what either side actually stood to gain from it.
I think the motivations of the buyer and the seller, Govind, are completely different. Just a week back, or maybe 10 days back, I did this piece when this news about Dharma talking to various people, which was the list included Adani, Reliance, and Saregama. And I think the day I filed that story, Saregama, in that evening itself, Saregama said that there was nothing of material interest to be revealed yet to the stock markets. It was a listed company. Unfortunately, Karan or Apurva both haven't spoken to me, and nor has anybody from Saregama, and nor has anybody from the Poonawalla group. I've been following up with them. But from whatever I understand from speaking to people within the business, one is a stage of life thing. So from the seller's perspective, it's a stage of life thing that Karan is over 50. I think at some point he does want to encash the equity he has. Secondly, that we must remember that this business is going through a transition phase. It's not a tough phase or a good phase or a happy phase. It's a transition phase. And the production of films, the whole making of content in India is an extremely fragmented business. This is a hill which Hollywood climbed 70 years back, maybe 100 years back. These are hills which we are just beginning to climb when OTT is taking off. Television is on the decline, is in genteel decline. So the point is the buyers are extremely consolidated. Remember, you have a Reliance Disney, you have a Netflix, you have an Amazon, large, big giants who can dictate prices and dictate creative terms. And the sellers, which are whether it's an XL, T-Series, Viacom. Now, Viacom, of course, is part of a far bigger group, which is Reliance Disney. I was just looking at the names, Dharma, all of them, Applause, Balaji. They all, everybody will be within 100 to 1,000 crore. I mean, T-Series is about 1,000 crore, if I'm not mistaken, last year. So in films, just in films, not the overall. But my point is these are smaller companies compared to the people who are buying stuff from them. Theatrical business is challenged. It's challenged not because people are not coming back to the theaters, but people are coming back less. And therefore, to get them there, you need to spend far more money. Getting people on OTT is not a problem. And selling stuff on OTT is not a problem. So you need more scale, you need and this is one business. I don't know if you noticed, Govind, there has been investment in distribution, there has been investment in technology, there has been investment in several other parts of the value chain. But investment in making content has only come from 2 or 3 players, which is Netflix, Amazon, and a few others. You don't have investment in content at scale. And ultimately, whether it's a newspaper, whether it's a television channel, or whether it's an OTT, they are all aggregators. So that business has got consolidated. These guys making films and TV shows are not consolidated. So from the seller's perspective, to go back to your question, this was an imperative. That consolidation is bound to happen. We said this, I've been saying this for, I think, almost 2 years now. And the consolidation that we saw with Reliance Disney, or we could have seen with Sony Z, it is but natural that it will happen at this end of the value chain. The only problem is there isn't enough money chasing these guys. They need strategic investors. And on the buyer's side, I don't know what it means for the Poonawallas. Is it a vanity buy? Is it that they genuinely want to diversify into films? Really, there could be a variety of motives here.
How do things look from here on? Again, in the context of the fact that this quarter or last few quarters, things have been somewhat tough. But this is, of course, cyclical. I mean, we could see new hits and things could turn around for the theatrical side at least.
No, theatrical side, since 3 has been a huge hit. It's doing better numbers than Jawan and Pathan did in the domestic market. If you take global box office gross, of course, Pathan, Jawan are bigger. But Sri's done well. Several other films have done well. So it's not, I don't think theatrically is so challenging that people will start. But the fact is, if these guys want to make more films at a scale where people come back to the theaters, or whether by the OTC, also you must remember that the streaming boom is over. All the streamers have cut their budgets globally over the last 1.5, 2 years. Disney is listed, so they had to cut back. Netflix is listed, they've cut back. Amazon has cut back. Everybody's cut back budget. So that party is over. That throwing money at shows and films, that is over. That was a phase. So ultimately, just like TV became a proportion of your film's revenues, of a film's P&Ls, streaming is becoming a proportion. Eventually, whatever you do, globally, theatrical brings in 60 to 70% of a film's revenue. If a film doesn't work in the theater, it does not make money. Period. You could say all you want, unless you're a 2 crore film and you've sold to the OTT for 2.5, then you're fine. Film has to make money in the theater. So it's based, it is what Balaji did to television production, if you think of it, or what Ogilvy did to advertising films. You have to bring scale, and getting scale into the creative business is extremely tough.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.